Indian macros are the best that they've ever been in the last 2-3 decades. Be it GDP growth, inflation is well under control. 3 months in a row, the inflation print has been below 4%. Our forex reserves have climbed up back to close to $700 billion. The currency has recouped the losses that it suffered in Jan and February. Plus, the monthly data point, the GST data which came yesterday, it's up 16% YOY, which is basically the best month in 18 months, right? So macro data points are perfect. Corporate earnings has also rebounded, as we just discussed. And globally, the headwinds which were there on geopolitics, there seems to be abating a little bit. So I wouldn't be surprised if we venture near the vicinity of 26,000 on Nifty towards the end of the year, because we'll still be going there with a gap of 15 months. So that would have allowed the valuations to cool off and at the same time earnings to adjust to those valuations. So I wouldn't be surprised if closer to December 2025, we inch up towards 26,000, because while that number looks psychologically big because it's all-time, but from here it is just a 4 to 5% kind of an upside. What I would, however, be more keen to observe is the breadth of the market, because the breadth of the market had suffered a little bit. The smaller caps, the mid caps, they've undergone decent correction, and for right reasons, because the valuations had become exorbitantly expensive back in September, October. Now, earnings have been very good for mid caps, right? Amongst the large, mid, and small cap, mid caps have delivered the best earnings. So it will be interesting to see how the valuation interplay with earnings happen over the subsequent 9 to 10 months. So that is more important for me rather than a static Nifty target.
Understood. Gautam, what could go wrong with this current setup, which is looking admittedly quite constructive? We still haven't seen the crowding in of private sector investment. There's the possibility of a flare-up in the Indo-Pak conflict, a global bond market sell-off, a collapse in the US-China trade detente. We're already starting to see those cracks. What could go wrong with this broadly positive consensus for the Indian market?
So as far as risks are concerned, we think the biggest risk will emerge from globe, pertaining to either a trade policy or a global geopolitical headwinds, not just limited to India, but other countries too. As far as India is concerned, we think we are in a quite a balanced space now. We have a RBI policy coming up. We're expecting another 25 basis point of a rate cut. So risk largely, which can damage the market durably and to a slightly higher magnitude, will stay mostly from global factors. We don't expect the domestic factors to cause much of a heartburn, because do remember that the flows have been exceedingly strong. Last year, Indian domestic investors invested $63 billion in calendar 24. This year, so far, first 5 months, we've already seen $33 billion from the domestic investors. And this is despite continued selling from foreigners. We've seen about $11 billion of selling from FIIs. So despite relentless selling from foreigners for the last 3 years now, cumulatively, if you add up the domestic flows, they are totaling to about $110 billion, which is a massive number, coupled with the monthly SIP book itself of $3 billion now. So flows will temper the downside and also withstand the volatility which is inherent in this kind of a market. But to answer your specific question, the risk largely stems from global factors.
Understood. Let's bring in selectively IT services, Gautam, pharma, car makers like Tata Motors, namely those with exposure, the most exposure to the export markets. What did earnings and guidance especially tell us about how those parts of the market are holding up?
So amongst the three sectors that you mentioned, pharmaceuticals look the safest right now, because both the domestic formulation segment as well as the US market, the two very important contributions to total revenue and profit pool of pharmaceutical sectors, they're looking quite okay. In fact, this quarter also, pharma delivered a good double-digit earnings. This is now the 8th consecutive quarter of 14-15% kind of an earnings growth for pharma sector. So that looks quite okay to us. And within pharma, obviously, hospitals are outperforming the traditional generic names. The concern largely stems around the US IT spending, because that is where the biggest challenges persist around this whole trade policy and flip-flops in the US. So what we were expecting 6-9 months back, that discretionary spending in IT, which is technology in US, will revive somewhere towards the second half of FY25. We've changed that stance 3 months back. So we are now expecting the discretionary IT spending to revive only in second half of FY26. So therefore, the tech stocks could remain slightly more range bound. And our usual thesis has been that in any year, if you look at India, the banks and IT stocks do not outperform together ever. The only exception has been the year CY17 in last 20 years. This year, so far, already in the first 5 months, the banks index is up 10% and IT index is down 14%. So we don't
Yes.
expect IT to start outperforming banks. Our preference remains more towards bank, consumer
Yes.
discretionary, industrials, and IT we like because of valuations.
Understood. Gautam, and just on the banks, Goldman Sachs upgraded the sector last month. How convicted are you towards the banks and financials? And can you name names? Who is emerging as best of breed? Because I've been hearing that the consensus top pick is ICICI. Is that the best way to express
ICICI Bank is also
an overweight position
idea.
in the banks and the financials?
Sure. So we do like financials. We have an overweight stance on entire BFSI sector. In private banks, we of course like ICICI Bank. It's a consensus top idea for both buy side and sell side. But aside of ICICI Bank, we also like Kotak Mahindra Bank. However, the real alpha, in our view, in financials will come from non-banks, which is the NBFCs and at the same time the non-lending NBFCs, basically the capital market stocks. We have a very positive view on capital market names like Angel, Bombay Stock Exchange, HDFC AMC, Nuvama, and within the lending NBFCs, we continue to prefer, Shriram Finance. We also like Chola Finance and Bajaj Finance. So we think, given the rate environment that we are in, and we are expecting another rate cut in this monetary policy, as we move forward 6 to 9 months, the cost of funds will become a bit more benign for the lending NBFCs. So while we like banks, we think the alpha will be generated from non-banks within the financial space.
Gautam, I hope you don't mind me putting you on the spot a bit, but NSE, if and when it does come to market, and we all know how it's mired in something of a running battle and a challenge with SEBI over what it needs to do to change before it gets to an IPO. But if and when it does, would you be a buyer of NSE?
Absolutely. But do remember that NSE is, I don't know the exact valuations prevailing in the private markets, but the stock has done really well in the unlisted space in the last 6 odd months. However, I do expect that whenever it comes for listing, there will be a massive demand for that stock. It's a virtual monopoly. And given the kind of inherent shifts that we are witnessing in the domestic savings pool and the preponderance of the savers to move towards equity, I think NSE will become a stock which virtually becomes an allocation stock for everyone in their respective portfolios.
Thank you for addressing that, Gautam. How are you approaching broadly these new public listings? Because Schloss Bangalore underwhelmed yesterday. Many new entrants are frankly not profitable or don't seem on a path to sustained profitability. Is that a reflection of the misalignment that we have been seeing between private and public market valuations?
See, look, IPO's performance is always a function of the market sentiments. Right now, the market sentiments, while they've improved from February, March, they're still not where they were 8-9 months back in September and October. So definitely IPOs, some of the IPOs may see a very tepid or a lukewarm listing. Second, in many spaces, wherever the listings are happening, there are already well-established incumbents which are present there. So a lot of investors might think of, increasing their allocation in their existing stocks in the portfolio in the same sectors. Second, as you rightly pointed out, valuations, there is always going to be a little bit of a mismatch between primary and secondary market. And that is what we are also seeing at play. But I think as we move forward, as the sentiments improve further and corporate earnings pick up, you might see IPO markets reviving faster than what we are imagining right now, because they've always been very volatile. So, but yeah, of course, from an investor's point of view, one has to be very, very selective on both valuations and underlying corporate fundamentals of the listings which are happening.
Gautam, but are the longer-term drivers of stocks like Ola Electric and the two-wheeler EV segment, or Swiggy and e-commerce, and we've seen that area rapidly undergo change with premiumization, quick commerce. Does that mean turnaround is on the horizon and sustained profitability is on the horizon and that will come? Or is the business model and management fundamentally flawed?
So we are very positive on quick commerce. So the names that you mentioned, Zomato, Swiggy, and even the unlisted ones like Zepto, as a house, we've been extremely positive on this sector for last 2-3 years. What is going to change there is the visibility of a long-term growth is very, very benign there. The sector itself at a top line level is growing at 20%. And within that, some of the companies which are executing well will have the opportunity to compound upwards of 25 to 30%. And with that comes the operating leverage and scale. And we do expect both Swiggy and Zomato to have a decent profitability in the next 2 to 3 years. What has changed the game? I mean, it had begun with food delivery. And in the last 12 months, we are talking mostly about quick commerce. Food delivery has become a relatively more stable 17-20% kind of a growth segment. However, quick commerce is growing at 5 to 6% month on month, which essentially means on an annual basis, they're growing at 50-60%. Very difficult to find such kind of a growth in traditional old school consumer stocks, which are growing at 4-5% max. So definitely we do expect major wealth creation to still happen in this space. As regards EV, I think it's going to be a bit of a tricky proposition because EV penetration is still very, very low single digits in India. It'll take a lot of time and a lot of money and cash burn will happen there. Second, the competition will also evolve. So EV, it is not as clear to me right now. However, on the quick commerce side, we are very clear that this is a space which over the next 3 to 5 years is going to create tremendous wealth.